Silver premiums in India rise to $8 over the COMEX. $8. For those who understand commodity markets, that number should stop you cold, because in a functioning market, premiums don't behave this way. They whisper, they don't scream. But right now, across India's industrial corridors, manufacturers are paying $8 above global prices just to access physical metal. This isn't a shipping delay. This isn't a temporary squeeze. This is something the financial press hasn't named yet. And while New York trades paper contracts with ease, factories in Mumbai, Delhi, and Bangalore are discovering something unsettling. The metal isn't where the price says it should be. The question isn't whether this matters. The question is, what breaks first when the gap becomes impossible to ignore? Welcome to John A.G. Now, if you've made it this far into the analysis, you clearly value substance over noise. So let me ask you something. The way I'd ask a seasoned colleague over coffee, have you subscribed yet? I know. Everyone asks for subscriptions these days, but here's the difference. This channel doesn't chase trends. It tracks patterns that matter before they become headlines. If you've spent decades in business, or if you're building something that requires you to see around corners, you already know the value of early signals. So do me this favor, hit that subscribe button, not for the algorithm, but because you recognize analysis worth returning to. And while you're at it, drop a comment and let me know, where are you watching this from? What region of the world are you tracking these market shifts from? Because economic pressure doesn't respect borders, and neither should our perspective. Now, let's examine what's actually happening beneath this $8 anomaly. In the first week of January 2025, something unusual began appearing in trading rooms across Mumbai. Silver dealers were quoting prices that didn't make sense to anyone familiar with how global markets typically function. The gap between what COMEX futures showed in New York and what actual buyers had to pay in India had stretched to $8 per ounce. $8. To an outsider, this might sound like a minor detail, a rounding error in a complex system, but to anyone who understands commodity markets, this number represents a fracture in how the global economy is supposed to work. Under normal conditions, premiums exist. They always have. A buyer in India typically pays 50 cents to $2 above the COMEX spot price, sometimes slightly more during festival seasons, when jewelry demand spikes. These premiums cover shipping costs, insurance, import duties, refining charges, and the profit margins of intermediaries who move metal across continents. This is standard practice. This is how physical commodity markets have functioned for decades. But $8 is not standard. $8 is not a shipping cost. It is a signal, and signals of this magnitude don't emerge without cause. COMEX, the New York-based futures exchange, has served as the global price-setting mechanism for silver since the 1970s. Every day, traders buy and sell contracts representing millions of ounces. Most of these contracts never result in physical delivery. They are financial instruments, bets on future price movements, hedges against currency fluctuations. The system works because market participants trust that physical metal exists somewhere, in vaults, in refineries, ready to be delivered if contracts are exercised. The price discovered through these paper transactions then becomes the reference point for the entire world. A jeweler in Jaipur, a solar panel manufacturer in Gujarat, a bullion dealer in Chennai, all base their purchasing decisions on what COMEX says silver is worth. But what happens when the paper price and the physical reality begin to diverge? What happens when the metal that should be available isn't? India consumes approximately 9,000 to 10,000 metric tons of silver annually. This makes it the second largest consumer of silver in the world, trailing only the United States. Unlike investment-driven demand, India's consumption is overwhelmingly industrial and cultural. Solar panel manufacturing alone accounts for nearly 35% of total demand. Electronics, medical devices, conductive coatings, water purification systems, each sector depends on steady silver supply to maintain production schedules. Then there is jewelry and silverware, deeply embedded in wedding traditions and religious practices. This is not discretionary demand that vanishes when prices rise. This is structural consumption, the kind that adjusts slowly, painfully. And here lies the critical insight. When premiums spike to $8, it means something is broken in the supply chain. It means that despite COMEX showing ample liquidity in paper contracts, physical metal is not reaching Indian buyers at expected rates. It means someone, somewhere in the global distribution network, cannot or will not deliver at the quoted price. Premiums function as economic pressure gauges. When they rise modestly, they indicate normal supply-demand adjustments. When they explode, they indicate systemic stress. The current premium level suggests that Indian buyers are willing to pay significantly above global prices simply to secure metal for immediate delivery. This is not speculative positioning. This is industrial desperation masked in procurement terminology. Solar manufacturers cannot halt production lines waiting for lower prices. Electronics assemblers cannot delay orders while hoping for premium normalization. They pay what they must pay, and they pass costs forward wherever possible. But cost pass-through takes time. Contracts were signed months ago at different price assumptions. Margins evaporate first, then come the difficult conversations with clients about price revisions. The $8 premium is not merely a number on a trading screen. It is a tax on every solar panel manufactured in India over the coming months. It is a hidden inflation component in consumer electronics. It is a margin compression event for thousands of small and medium manufacturers who operate on thin profitability cushions. And most importantly, it is a question mark. Because if this premium persists, it suggests something fundamental has shifted. If it widens further, it suggests the fracture is deepening. The global silver market was supposed to be liquid, transparent, efficient. Yet right now, buyers in the world's second largest market are behaving as though metal is scarce. The natural question becomes, why? What happened to the supply chains that reliably fed Indian demand for years? Where is the metal, and why isn't it moving? Claude is AI and can make mistakes. Please double-check responses. 6 months before Indian premiums hit $8, something happened in London that most people never heard about. It didn't make headlines. There were no emergency announcements. But in the vaults beneath the London bullion market, metal started disappearing faster than it was arriving. London is not just another trading hub. It is the physical heart of the global precious metal system. The place where East meets West, where miners send metal for refining and certification, where central banks and institutions store reserves. For decades, London's vault system operated with quiet efficiency. Metal flowed in from mines in Mexico and Peru, from refineries in Switzerland, from recycling operations across Europe. It flowed out to manufacturers in Asia, to mints producing coins, to jewelers and industrial users worldwide. The system balanced itself, supply meeting demand, inventories rising and falling within predictable ranges, until autumn 2024. That's when the withdrawals began outpacing deposits. Week after week, vault operators watched their inventory numbers decline. Not dramatically at first, just enough to notice, just enough to require closer monitoring. But the trend didn't reverse. By October, the people who manage these vaults, the ones who never panic because they've seen every market condition imaginable, started making quiet phone calls. They needed metal, not next month, not through normal supply channels, immediately. And here's where the story takes its first critical turn. The metal that saved London came from China and the United States. Emergency shipments were arranged. Silver was pulled from Shanghai futures exchange warehouses, from COMEX-approved vaults in New York and Chicago. The metal moved, the pressure eased, and London stabilized. Problem solved, except it wasn't solved. It was transferred. Because every ounce that left Shanghai to rescue London was an ounce that Chinese manufacturers could no longer access locally. Every ounce pulled from American vaults was an ounce removed from the Western Hemisphere's available supply cushion. The rescue didn't create new silver, it simply relocated existing inventory, plugging one hole by opening others. And now, those other holes are becoming visible. Shanghai futures exchange inventories, which once held comfortably above 1,500 metric tons, have collapsed. Current figures show warehouse stocks below 1,000 tons, in some recent reports, approaching 800 tons. To put that in perspective, China's industrial silver consumption runs approximately 6,000 tons annually. At current inventory levels, Shanghai's warehouses hold roughly 6 to 7 weeks of national industrial demand. Not 6 months, not a comfortable buffer, 6 weeks. This is the economic equivalent of living paycheck to paycheck, except it's an entire industrial sector operating hand-to-mouth on critical material supply. Meanwhile, something equally important was happening with the metal itself. Silver doesn't teleport between markets. It requires physical movement, ships, customs clearance, refining to meet regional specifications. London Good Delivery bars, the standard format in Western markets, are 1,000-ounce large bars, but many Asian manufacturers prefer smaller formats. Kilobars, grain, form suited to industrial processes. This means metal arriving in Asia often requires re-refining, adding time, adding cost, adding complexity. Under normal circumstances, this refining capacity operates with spare room. Refineries process metal, build small inventory buffers, and ship to customers with predictable lead times. But when emergency demand spikes, when metal needs to move from London to Shanghai to satisfy urgent orders, refining becomes a bottleneck. There are only so many refineries certified to handle large-scale conversion. They can only process so many tons per week, and they were already operating near capacity before the London crisis. Now consider what this means for India. India imports roughly 85% to 90% of its silver consumption. Traditionally, that metal came from multiple sources: Peru, Mexico, Australia. sometimes China when Chinese domestic demand slackened. But if China is now drawing down its own inventories, it's not exporting surplus. If London needed emergency supply from global vaults, those vaults are depleted. If refineries are backed up processing metal for multiple urgent regional needs, delivery times extend. Indian buyers are discovering that their traditional supply channels have friction. Orders placed with international suppliers are being quoted longer delivery windows. Some suppliers are requesting higher deposits, indicating uncertainty about their own access to metal. Letters of credit that once cleared smoothly through banking channels are experiencing unusual delays, not dramatic, just enough to slow the process. And in commodity markets, slow equals expensive, because when a solar manufacturer needs silver for production scheduled 3 weeks out, they cannot wait 6 weeks for optimal pricing. They pay the premium, they secure the metal from whoever has it available, and they adjust their cost structures accordingly. This is why the $8 premium isn't just an Indian story. It's the downstream consequence of a global supply chain that experienced stress in one location, responded by pulling resources from other locations, and is now discovering that those other locations don't have surplus either. The metal exists somewhere. Total global silver production hasn't collapsed. Mines are still operating. Recycling still functions. But the distribution system, the intricate network that moves metal from producers to consumers across continents, is stretched. And when systems stretch, inefficiencies appear. Premiums are simply the market's way of pricing those inefficiencies. $8 is what it costs, right now, to navigate a supply chain that is no longer operating smoothly. The question nobody can answer yet is, how long does this last? There's a factory in Gujarat that nobody outside the solar industry has heard of. It doesn't advertise. It doesn't have a consumer-facing brand. But every month, it produces enough photovoltaic cells to power approximately 15,000 homes. And right now, its procurement manager is doing something he's never done in 14 years of managing supply chains. He's buying silver 3 months ahead of production schedules, locking in prices he considers unsustainable, and hoping his CFO doesn't ask too many questions about the cash tied up in inventory, because he understands something that hasn't shown up in quarterly reports yet. The $8 premium isn't a temporary blip. It's a cost structure reset, and his company is one of thousands trying to absorb it before it becomes unmanageable. Solar panel manufacturing is deceptively silver intensive. Each gigawatt of photovoltaic production capacity consumes roughly 80 to 100 metric tons of silver annually. The metal forms the conductive paste printed onto silicon wafers, the microscopic network that captures and channels electrical current. There is no substitute that performs equivalently at commercial scale. Researchers have explored copper alternatives for years, reducing silver content per cell incrementally, but complete elimination remains technologically unfeasible. Silver is embedded in the physics of how solar panels work, and India's solar ambitions are enormous. The government has set targets of 500 gigawatts of renewable energy capacity by 2030. Manufacturing clusters in Gujarat, Tamil Nadu, and Andhra Pradesh have been ramping production to meet both domestic demand and export opportunities. The Production-Linked Incentive Scheme, a government program offering financial incentives for domestic manufacturing, has attracted billions in investment. New factories are coming online quarterly. Capacity is expanding. Except now, the fundamental cost assumption underlying these business plans is changing. And when project finance models were built, when investors committed capital, when companies signed long-term supply contracts with developers, silver was assumed to trade in a certain range. Premiums were assumed to remain within historical norms. An $8 premium wasn't in anyone's spreadsheet. Here's the mathematics that keeps financial controllers awake. Silver represents approximately 8% to 12% of total solar module manufacturing cost under normal conditions. When premiums add $8 per ounce, and a typical module requires roughly 0.6 to 0.7 ounces of silver, the direct material cost increase approaches $5 to $6 per module. A standard 500-watt panel might wholesale for $120 to $150 depending on specifications. $5 doesn't sound catastrophic until you multiply across production volume. A factory producing 2 gigawatts annually, roughly 4 million modules, is suddenly facing $20 million in unexpected input costs. For a company operating on 6% to 8% net margins, this is not a rounding error. This is the difference between profitability and losses. And solar manufacturers cannot simply pass these costs through immediately. Most operate under fixed price contracts signed months earlier. A developer who ordered 50 megawatts of panels 6 months ago locked in a price based on silver at different levels. That contract is binding. The manufacturer must deliver at agreed pricing, regardless of what happened to input costs afterward. This is margin compression in real time. The company absorbs the loss on current contracts and attempts to renegotiate pricing for future orders. But renegotiation is not straightforward, because their customers are also operating under fixed agreements with end buyers. The entire value chain is temporarily misaligned. Everyone locked into pricing that reflected a different cost reality. Eventually, prices adjust, but eventually means quarters, not weeks. Meanwhile, working capital requirements explode. That procurement manager in Gujarat buying 3 months forward, he's converting liquid cash into inventory. Silver sitting in bonded warehouses. Metal that won't be used for 90 days. This ties up capital that could finance other operations. It requires larger credit lines from banks. It changes the company's financial profile, increasing leverage, reducing flexibility. And he's not alone. Across India's industrial landscape, procurement teams are making identical calculations. Electronics manufacturers face the same dynamics. Silver is critical in semiconductor packaging, in multi-layer ceramic capacitors, in specialized switches and contacts. A smartphone contains approximately 0.3 grams of silver. Seems negligible, until Samsung or Xiaomi manufactures 50 million units annually from their Indian facilities. That's 15 metric tons of silver. And when premiums spike, the cost delta flows directly into already compressed electronics margins. Medical device manufacturers, water purification companies, electrical contact producers, each sector is quietly recalibrating. Some are exploring inventory financing arrangements, borrowing against stored metal to preserve cash flow. Others are approaching suppliers about consignment agreements, metal held on site but owned by the supplier until actually consumed in production. A few are having more difficult conversations about production cuts, about capacity utilization reductions, about whether certain product lines remain viable at current input costs. These decisions don't make headlines. They appear months later in earnings calls as operational adjustments or strategic portfolio optimization. But in real terms, they mean workers sent home, orders declined, growth plans postponed. The macroeconomic implications extend beyond individual companies. India's current account deficit, the gap between what the country imports and exports, is sensitive to commodity prices. Silver imports typically represent a modest but measurable component. When premiums force Indian buyers to pay $8 above global prices, it effectively increases the cost of imports without any corresponding increase in export revenues. This widens the trade deficit, it puts pressure on the rupee, it complicates the Reserve Bank of India's monetary policy decisions, and it creates inflationary transmission mechanisms that take time to fully manifest. A solar manufacturer absorbing higher costs today will eventually pass them through when contracts allow. Developers will incorporate higher module costs into project bids. Electricity purchase agreements will reflect these costs. End consumers, whether residential rooftop installations or large commercial buyers, will ultimately pay more. The $8 premium that started in commodity trading rooms in Mumbai will eventually show up in electricity bills in Kerala. Not immediately, not directly, but inevitably. Because in integrated economies, cost shocks don't stay isolated. They propagate through supply chains, through contract structures, through pricing mechanisms, until they touch everyone. The procurement manager in Gujarat understands this. That's why he's buying forward despite the cash flow pain, because he's betting that $8 today is cheaper than whatever comes next. And he's not certain, but increasingly convinced that what comes next might be worse. The $8 premium is asking a question that commodity markets hate answering. Is this temporary, or is this the new normal? Because the answer determines everything. It determines whether companies build inventory buffers or wait for normalization. It determines whether investors view solar manufacturers as facing a quarterly headwind or a structural challenge. It determines whether the current situation is a procurement problem or an early warning of something larger shifting beneath the surface of global metals markets. And right now, the indicators are contradictory. On paper, global silver supply looks adequate. Mine production in 2024 reached approximately 830 million ounces worldwide. Mexico, Peru, China, Australia, Poland, the major producing nations maintained output. Recycling added another 180 million ounces from industrial scrap. Old jewelry, photographic waste, electronics recovery, total supply exceeded 1 billion ounces. Meanwhile, total demand, including industrial consumption, jewelry, silverware, coins, and investment, came in around 1.2 billion ounces. A deficit exists, but not a catastrophic one. The shortfall has been filled by inventory drawdowns and recycling adjustments for years. So why the premium spike? Why the supply strain in specific regions despite apparently sufficient global production? The answer lies in something economists call market segmentation. Silver is not a truly global commodity in the way crude oil is. Oil flows to wherever prices are highest. Ships redirect mid-voyage. Supply responds fluidly to demand signals. But silver moves through established refining networks, regulatory frameworks, financing channels that don't adjust instantly. A mine in Peru produces silver in forms acceptable to London refineries. That metal enters the London good delivery system, gets certified, and becomes part of Western market supply. Moving that same metal into Shanghai's market requires re-refining to meet Chinese standards. Moving it to India requires navigating import duties, customs procedures, banking arrangements specific to Indian trade finance. These aren't insurmountable barriers, but they're friction. And when multiple regions experience supply tightness simultaneously, that friction becomes expensive. The London Vault strain of autumn 2284 was the first crack. The emergency metal movements from Shanghai and New York were the response. The inventory depletion in China was the consequence. And India's $8 premium is the downstream effect. Each event connected, each creating conditions for the next. This is what cascading supply chain stress looks like in commodity markets. Not a single catastrophic failure, but a series of smaller dislocations that compound. Now overlay the monetary policy environment. Central banks globally have been navigating inflation concerns and growth slowdown simultaneously. Interest rate policies have fluctuated, creating volatility in currency markets. The US dollar, against which most commodities are priced, has experienced significant swings. When the dollar strengthens, commodities typically become more expensive for buyers using other currencies. Indian importers paying in rupees feel this acutely, but there's a deeper dynamic at play. Precious metals, silver included, function partly as monetary hedges. When confidence in fiat currency systems wavers, even slightly, investment demand for physical metals increases. This isn't speculation about financial collapse. It's simple portfolio diversification. Institutions and high net worth individuals allocating a slightly higher percentage to tangible assets. That marginal increase in investment demand, perhaps 30 to 50 million ounces globally, is enough to stress an already tight physical market. Because investment buyers, unlike industrial consumers, tend to hold rather than recycle. Metal that flows into vaults and safe deposit boxes doesn't return to circulation quickly. It becomes effectively removed from available supply, at least temporarily. So the question becomes, how does this resolve? There are three possible paths forward. First, prices rise high enough to destroy marginal demand. Some industrial applications become uneconomical. Manufacturers reformulate products to use less silver. Substitution accelerates where technically possible. Jewelry demand weakens as retail prices increase beyond consumer willingness to pay. Investment buyers decide silver has run too far and rotate into other assets. Demand destruction brings the market back into balance. This is the classical economic response. Painful, but predictable. Second, supply responds. Miners increase production from existing operations. Marginal mines that were unprofitable at lower prices restart. Exploration accelerates in promising regions. Recycling intensifies as higher prices make recovery operations more profitable. New refining capacity comes online to ease bottlenecks. Supply catches up to demand. Inventories rebuild. Premiums normalize. This is the optimistic scenario, but it requires time. Mines don't expand overnight. Refinery construction takes years. Supply response is measured in quarters and years, not weeks. Third, the market fragments permanently. Regional pricing diverges persistently. Premiums become structural rather than temporary, and the idea of a single global silver price becomes obsolete. London prices one level, Shanghai another, India yet another, each reflecting local supply-demand conditions rather than globally arbitraged values. This is the scenario that challenges fundamental assumptions about how commodity markets function. It suggests the interconnected global trading system that defined the past several decades is reorganizing, not collapsing, but shifting into something less seamless, more regionally defined. Which path will actually unfold? The honest answer is, the market is still deciding. And in that uncertainty lies both risk and opportunity. For businesses currently navigating this environment, certain principles apply regardless of which scenario materializes. First, procurement strategy must evolve from just-in-time to just-in-case. Lean inventory management worked beautifully when supply chains were reliable and predictable. But reliability has degraded, and predictability has diminished. Building strategic inventory buffers, even at the cost of tied-up capital, provides operational stability that increasingly justifies the expense. Second, supply relationships matter more than transactional pricing. A supplier willing to guarantee delivery during tight markets is worth more than one offering the lowest quote during abundant times. Long-term partnerships, framework agreements with volume commitments, these structures provide security that spot market purchases cannot. Third, financial hedging has limitations in physical commodity markets. Paper contracts can offset price risk, but they don't guarantee physical delivery. A manufacturer can hedge silver prices perfectly on COMEX and still face an $8 premium for actual metal. Understanding the difference between financial exposure and operational exposure is critical. Fourth, flexibility in product design and manufacturing processes provides resilience. Companies that can adjust silver content, switch between suppliers with different material forms, or temporarily shift production to less silver-intensive product lines can navigate disruptions more effectively than those locked into rigid specifications. And finally, information matters. The companies navigating current conditions most successfully are those monitoring not just prices, but inventories, shipping times, refinery backlogs, regulatory changes, banking settlement patterns. They're tracking the operational indicators that provide early warning of supply stress before it shows up in premiums. The $8 premium in India is not merely a number. It's a pressure reading on a system under stress. Whether that stress proves temporary or structural will determine the business landscape for years ahead. For now, the market is sending a signal, and those paying attention, those adjusting strategy before adjustment becomes crisis management, are positioning themselves for whatever comes next. Because in commodity-dependent industries, the companies that survive disruption are not the ones with the best prices. They're the ones with the most reliable supply. And right now, reliability costs $8 more per ounce than it used to. The only question is, what will it cost tomorrow?